Hi, everyone. Welcome to the AAA-ICDR Risk Management Webinar Toolkit. We're just going to give everyone a couple of seconds to join us and dial into the webinar before we start proper. All right. Thanks so much, everyone. Welcome to episode 3, titled MythBusters, Third-Party Funding and Insurance. I'm very happy to have with me 3 exceptional guests this afternoon, all of whom are great friends. So the first, Tom Hunt, is an Associate Director at Aon M&A and Transaction Solutions, where he leads the development of Aon's after the event or ATE portfolio across EMEA. A former litigation risk underwriter, Tom helps clients transfer litigation risk through tailored insurance products, offering a unique perspective on creative risk management solutions. Up next, we have Mitchell Dearness. Mitch is also a webinar series coordinator for the AAA-ICDR Risk Management Toolkit. Mitch is an investment manager at Omni Bridgeway based in Singapore, where he originates and manages funded disputes across Asia and beyond. Formerly a senior associate with Herbert Smith Freehills, Mitch brings deep experience in complex energy and infrastructure disputes, helping clients navigate risk and liquidity through strategic dispute finance. Mitch is also a member of the ICDR Singapore Committee. Last but certainly not least, we have Katie Chung. Katie is an international arbitration specialist at Norton Rose Fulbright and is also a member of the ICDR Singapore Committee. She has over a decade of experience representing clients in high-value cross-border disputes. Based in Singapore, Katie acts as both counsel and arbitrator in proceedings under major institutional rules, with particular expertise in the energy, commodities, and tech sectors across Asia. So now that you've had a better understanding of our fantastic faculty for this afternoon, let me give you a glimpse into what it is that we've covered so far. So we've talked about everything you need to know before you get into a dispute, as well as the considerations that you might want to bear in mind pre-dispute in relation to third-party funding as well as insurance products. We've also looked at a variety of third-party funding and insurance products to give you a better understanding of the options that are available to you when a dispute arises. We've also looked at the interplay between disclosure, financing, and risk management, as well as regional developments in third-party funding and insurance across Asia, including emerging trends in strategies that are employed not just by parties, but by the funders and insurers themselves. Today, we have an opportunity to put the funder and the broker in the seat and ask them hot topic questions. So Katie's going to kick us off this afternoon.
Thanks, Tara. So the first question has got to do with the myth that funders and insurers may be seen as competitors. And so the question is, are they actually rivals, or do they each serve distinct functions in managing disputes risk? And I would invite Mitch to start and Tom to follow.
Thanks very much, Katie, and thank you everyone for joining today. I think this is largely a myth, and often insurance and funding products are complementary. I think what's key is knowing which products are available and which risks they can be used to mitigate. I think often a key point of difference is that many insurance policies are negotiated and entered into very early on before a dispute arises. For example, at the time of investment, whereas litigation funding really only becomes a product when the dispute is arising and it's available then. So I think that's one key difference. Another key difference perhaps is that the models are different. So in a funding arrangement, obviously you have the funder deploying capital, to pay for the dispute, which gives rise to other benefits, not just in relation to risk management, but also in relation to the claimant's profitability and financial performance whilst the dispute is on foot. So I think by and large they're complementary and they can offer protection over different risks.
Yeah, I would agree that they are complementary for sure. So very often we work closely with funders, particularly to provide AT insurance. So if a claimant is being funded in a dispute, then the funder may suggest that they obtain an after the event insurance policy, which protects the adverse cost exposure. So in that way, it's very complementary. There are some competitive products, but those are very nascent and not being used very often at the moment. And they don't solve the same problems as funders because the insurers are never going to provide cash flow to a claimant or their legal team to pursue a dispute. We also do work together as clients. So, for example, we may provide capital protection insurance to a funder, but that's a whole different conversation as well.
Okay, so now that we have established you're actually friends,
Yeah.
can a case benefit from both funding and insurance at the same time? I mean, the classic pairing is funding plus ATE insurance, which tends to come, hand in hand. Are there situations where you would have a different type of insurance combined with funding?
An extension on that, Katie, might be, for example, certain funders have an ATE policy that's supplied over a whole fund or a whole portfolio. And because of that diversification, that the insurance pricing that the clients benefit from may be more competitive than a single case policy. So I think that's really a key thing. The objective of any funding model is just to ensure that all of the client's downside risk is transferred, and a part of that is obviously ATE risk.
Yeah, absolutely agree with that. So yeah, often as Mitch says, the funders are providing an indemnity for adverse costs, which is then backed off by an insurance policy, or they're just simply the claimant getting their own insurance policy before the dispute has kind of really kicked off and funding's been obtained.
Yeah, and then also there's the example of the capital protection insurance that sits on top of the fund itself.
Exactly. So that would be the investor that is insured into that. So it's normally across a portfolio of cases or an entire fund where the insurer is essentially taking principal protection risk. Whereas, so if a set of investments into some legal assets don't return the anticipated principal, then the insurer will pay the difference. So, for example, if 100 million is invested into 5 cases and they only return 80 million, then 20 million will be paid out by the insurer, just as a very simple example.
And turning to, if where clients are looking at funding insurance, some users of international arbitration, see litigation funding as expensive capital. That's another myth that we've got to bust today. Is that correct, Mitch? I mean, how do you determine your pricing for litigation funding? If you're telling me, to giving me a songbook to speak to in-house counsel and the legal teams there to convince them to do funding, what's the songbook you would give me?
Well, I'm glad you categorized that as a myth, because I think it's also a misconception in that it's fundamentally different form of finance to traditional debt finance. So when you go to a bank and you get a loan, the bank will ensure that you pay it back no matter what. You must pay that back. They will sue you. They will seek to recover that money for you. But because third-party funding is non-recourse financing, the funder only realizes a return if your claim is successful. And by that, we mean recovery. So I think it's fundamentally different. And then when you're considering whether or not it's expensive, think about some other things. First, think about the cost of self-funding the dispute for your business, how will that impact your profitability as a business if you're paying lawyers and experts a lot of money every month to manage your disputes? Perhaps think about it through that lens as well.
Yeah, I mean that's absolutely right. I mean, in terms of the expense of the capital, I think one of the myths also that we're going to bust today has got to do with control. So you take capital from the funder, and then people say, ah, but you give up control because that's the cost benefit analysis. You take money from somebody, but in the end, you got to give up something. It's always pros and cons. So, Mitch, do you agree with that, or is that something that you want to bust as well?
I'd very happily bust that one. But I think first I need to distinguish between different types of funding deals. So one deal is a monetization deal, and that's effectively when the funder buys your debt or buys your award. If you have an award that you can't enforce, you can sell it. And so, of course, the funder then takes over and your relationship with them may be limited going forward. But that differs a lot from the typical funding arrangement where the claim rests with the client. Funders' job, or how we generate value for our funds, is identifying new investments, and then also what we don't generate value from is being heavily involved in ongoing investments. The ideal position to be in is that they go smoothly and there's nothing to worry about there. Of course, there are obligations in the LFA or a funding agreement. Funders are investing a lot of money into your dispute, so they need to be informed. But they're not allowed, we're not allowed, and we don't want to come in and tell the lawyers to do something or not. We don't have the right to do that, and it just shouldn't happen.
Yeah, that was another myth that was, that's often in circulation, that the funder can tell the external counsel team what they can or cannot do, and there's always a tension that sometimes arises because of that. I want to turn to Tom and ask a question about the pricing for insurance, because we've been talking about so-called expensive capital for litigation funding. And I want to ask Tom, how about pricing for insurance? Like Mitch
Yeah.
earlier mentioned, the monetization part of funding, where you take up an award and give some money to somebody, and then you take up the rights to enforce it later, recover the amount of the award. Could you perhaps speak to the pricing for different types of insurance that are available, including the arbitral award default insurance? That's quite an interesting product offering.
Yeah, absolutely. So we'll touch on arbitral award default first then. So that essentially is a product that you can, as a claimant, purchase before the award has been rendered. So you don't know the outcome, but you're against a state or a state-owned entity, and you think there might be an issue with default, or you just want to ensure that payment is going to be kind of forthcoming quite quickly after the award is rendered. So you can buy this policy pre-award. The pricing for that is much lower. The pricing for than if you buy it post-award. In terms of the structure for that, so really the premium is always as a rate online. So a rate online against the limit of the insurance that you buy. So a 10% rate online against 100 million is 10 million premium. Okay, so we're always talking in percentage terms and rates online. In terms of the premium pricing, it's always determined by the country and their grading. So, what goes into that categorization is, their track record of paying awards, the credit rating, and the political stability in the country at that time, and kind of what the outlook looks like for the next few years for that country when they're going to have to pay that award. So that's all the factors that go into pricing. We also have the post-award product, which is when an award has been rendered, the sovereign or state-owned entity has defaulted, and you purchase the policy at that time. Now, that leads to a longer gap between payment from the policy, up to typically 5 years, rather than 120 days like with the pre-award product. But the pricing is much higher on that because obviously they have already defaulted and there is an enforcement risk. that they have to proceed. So if I was saying roughly, it between 5 and 12% for the pre-award product, and kind of from 10 to 20% rate online for the post-award product.
Right. And just touching upon the premium where you sort of get the insurance, the arbitral award default insurance after receiving the award, is there some kind of efforts that needs to be demonstrated for enforcing the award in the first place in order to
so the claimant will approach the insurer with an enforcement plan. So they will have instructed an asset tracing firm to have undertaken, as they would do as an uninsured litigant, to kind of work out where the assets are, what all of that sort of thing. And that will be part of the underwriting process as well, that the insurers will consider. So that's a key part of the that what they'll do is often provide you with a non-binding indication of terms and say, okay, if we're satisfied by the asset report, then this is what the policy would look like, but go away and get that, and then we will confirm covers available.
Yeah,
and then they will agree the plan basically with you.
Got it. But the concept of this reasonable efforts of enforcement, is it correct that it doesn't necessarily apply if you get the insurance before the award is issued?
Yeah, so before the award's issued, exactly. So you have to, take initial steps to claim the award, but as soon as the sovereign defaults, the policy can then be claimed upon, or there's a 120-day waiting period after that. But so it's much quicker than the post-award product.
Yeah. Okay, so insure early, that's the advice.
Insure early, it's much cheaper and much quicker to get your money at the end. And funders do like that product as well, and any investor into that scenario, because there's a guarantee that at least a proportion. You don't have to insure the full award, you can insure just a proportion of that, and it just guarantees that at least some money is going to be coming out quicker, and then you can go and carry on with your enforcement above that amount, as you would.
And I want to turn to the fourth myth in this webinar today, and that's the myth that funders are only interested in blockbuster high value cases. Is that true? And would it even be conceivable to fund a lower value claim? Is that viable in practice? And is there an alternative if you have a $10 million case compared to a $1 billion case, right, which is blockbuster equivalent? What kind of products are we looking at, to bust this myth? Perhaps Mitch, you want to go into the blockbuster issues?
I would love to just fund blockbuster claims, but the problem is they're quite rare. At least in my experience, we're always on the lookout for them. But I think the practical takeaway is that funders do take risks, and we operate with a portfolio model. So it's really about the performance of the portfolio. Of course, we'd like to think that most claims are successful, but some aren't. And I mean, that reflects the fact that those clients have definitely benefited from our product. As to kind of quantum numbers, I think different funders approach this slightly differently. Some probably do have claim value thresholds, but we don't. Omni Bridgeway doesn't. Instead, we tend to focus on the economic viability of funding a claim. So by that, what I mean is that we look at the ratio between how much we think it will cost to fund and what we think the claim value is. So in your scenario, a $10 million claim, say, for example, we think it would cost $1 million or less. That would probably be economically viable to do. So it's really about ensuring that there is that sufficient delta between the budget and the claim size. That's how we really approach that decision.
And Tom, I mean, I think we had discussed possibility of insurance stepping in for a lower value claim.
Absolutely, yeah, absolutely. So certainly for adverse costs insurance, we've looked at policies for $100,000 of adverse cost exposure and upwards. All the way up to $40 million of exposure. That's the sort of range that we could comfortably work in. Obviously, at the higher end, we're having to syndicate insurers. Not one insurer is just going to write that, but that's absolutely fine. So yeah, I mean, the ATE insurance market really was born from insuring lower value, higher volume claims, and often those claims were run on CFAs. So a combination of CFA and ATE insurance also de-risk the position for the claimant, but obviously it doesn't de-risk it for the law firm, which is where funding comes in, and therefore the funding is more suitable for the larger cases to provide that cash flow. And obviously not all law firms are able to act on CFA arrangements or full CFA arrangements as well. So those are the alternatives from funding. Yeah, so absolutely available to cover all sizes of dispute.
And just to segue a little, let's say you have a series of these low value cases, but they form a substantial portfolio. Mitch, is what's the scope like for distinguishing between single case funding and portfolio funding? What are the metrics that you would apply in introducing portfolio funding?
Yep, and that's what we see quite regularly. So it's different portfolios of claims. It could be all smaller claims. It could be one big claim, one small claim. Could be two big claims. It could be some enforcement funding deals and some merits funding as well. So the analysis there is not on the single claim. It's really what's the value of all the claims in the portfolio, and what's the budget required to fund all of them. And on that basis, is the investment economically viable for us? So one of the major advantages there is that if the single case claim is just too small on its own, it may actually be viable as part of a portfolio because of that added flexibility.
Yeah, and I mean, just looking at the economic viability that you earlier discussed, the one other myth that I've come across is funding cases with only 80% above, chances of success. Some clients like percentages of success, right? So they like to put a number to report to management. Is that also the way that funders assess cases, or is there room for well-reasoned risks? What are the factors that you might look for to assess chances of success?
Yeah, we don't have, a threshold number like that on the merits. And often I think it's actually a trap that clients get themselves into, is just focusing so much on that, but also not considering enforcement risk, recoverability, and those other risk factors. So I think we take maybe a more holistic approach. We've definitely funded cases where we have got a legal opinion with a less than 80% prospects of success. But of course, we don't fund bad cases or cases that are even. There has to be a strong case, but in my experience, it's rare to find merits opinions with 80% plus prospects.
What would you regard as a strong case? So like a complex construction project, EPC contract, or pure contract interpretation, as an SPA deal gone wrong.
Yeah.
Between the two, and maybe an investor state case under BIT.
Yeah. So there, that's a lot to unwrap there. So it might need a little bit of time because they can all be quite different investments. So let me start with construction case, because I do quite a lot of construction funding. On face value, construction cases can look really complicated and too difficult. And that's one of the reasons why a lot of funders tend to stay away from them, because a construction case, as you know, Katie, they can involve many little claims in one. But the benefit can actually be that if you start to look at all those claims together, you can diversify risk a little bit. Even if some lose, if you can find where the money is, the investment might be kind of economic in and of itself. A bit like what I said before about portfolio funding. So looking at construction claims involves a lot of spreadsheets and a lot of numbers as well. So, but that can be quite a rigorous process. Investment treaty claims, almost always we face the issue of jurisdiction. It comes up kind of time and time again. So that often warrants quite close analysis. And then single case claims, yes, it's really the merits of that claim, but also recoverability and enforcement always. I guess I've just walked through that because when you understand that these claims often involve so much complexity or different issues, it's more complicated than just 80%, 60%, 70%. But of course, focusing very much on the merits, I think it's fair to say that you'd want something of at least 65%. At least we would feel that would generally be something that we'd consider investing in.
Yeah, I mean, to my mind, sometimes the contractual interpretation cases are the toughest ones because they are so finely balanced that you can't come up with a yes or no answer. Whereas for construction matter, it's really a yes no answer. Is there a delay or is there not? And how much is there?
Yeah.
What's the damage? Things like that. So it seems
Yes.
sometimes the complexity, if you just look beneath the surface a little bit, you'll find that actually it's a pretty simple case.
Yep.
But I want to turn to the assessment of percentage of success when it comes to enforcement and recoverability of an award, and that applies both to Tom and Mitch. In respect of the arbitration award default insurance that Tom you were earlier mentioning, what kind of how do you assess enforceability and recoverability in order to give the insurance to the insured? And I think for Mitch is how much does that play a part in determining the prospects of success, your economic viability as it were.
Yep, absolutely. So it's always a key part of any due diligence process. And we have a team that is just asset tracers that really focus on that at the start of the process. So rather than going to that number on the merits, usually how we look at this aspect is that when we're looking at the claim value, we try to work out not just what the legal or what the damages number might be. It's really what is the realistic recoverable number, because at the end of the day, that's what really matters. And then if we're approaching an investment in that way, we're not so much focused on the damages number. Instead, we're focusing on the recoverable number as well, and we approach the modeling on that basis.
Yeah, I would say insurers approach it in a very similar way, and often in these scenarios where arbitral default cover is being purchased, there is already an asset tracing team in place that have identified assets and setting realistic numbers of recovery. So that really goes into the underwriting pot. But often as well, there may be a funder involved, and so the funder we are working with the underwriter to present the risk in the best possible way, and that they will then instruct their own kind of counsel at that stage to just kind of ratify what they think they're thinking at that stage as well. So
it sounds like Mitch and Tom, there's actually just a whole lot of work that goes into this before either of you decide to take on a case. So if parties are looking at, going into taking on a funding arrangement or taking on or taking on an insurance arrangement, exactly how much due diligence effort is this going to take, and how should their in-house or external teams prepare for this without interrupting the fact that they are ongoing businesses and there's going to be a huge amount of other work that's going into revenue generation?
Yeah, I mean, I can take it from an AT insurance perspective because it's probably quite similar to Mitch's process, but can often be a little bit lighter. So often the underwriters that we are working with are all former litigators. They can make their own assessment of prospects and all of that good stuff. But normally we will be presented with a legal memo, and that will be either from the law firm advising or independent counsel. So that will essentially set out, the dispute in 10 to 15 pages. We'll also, if there are expert reports available, they'll also provide that. But if there aren't at this stage, then that's absolutely fine. And then it will be about the pleadings and everything like that. So are defences due yet? Are there any kind of other supporting documents that are available? for the insurers to analyse. And we say let's approach this early, so let's look at the case early. So often we're only seeing the claimant side of the case, and that's absolutely fine from an insurer perspective. And with ATE, it is a relatively light due diligence as long as there is that supporting case summary at the start that's including a merits analysis that shows prospects, enforcement, quantum are all can be reasonably assessed as with strong prospects. But of course, the insurer is taking quite a lot less risk than a funder might be. So hence why Mitch might have a slightly more detailed answer.
I think probably our process might be a little bit more rigorous, just as you say, because of the risk that we're taking on. Having said that, what a trend I've observed recently, and I encourage it absolutely, is that direct clients are coming to us very early about cases, and we enter into an NDA and we have a discussion about whether this is something that we might be interested in, and if so, how much might it cost? And we can do some modeling for them at that stage. And then that can give them a better sense as to kind of, is this worth our time or not? And so I think that can often be a helpful exercise. It's free. It doesn't cost you anything to talk to a funder at the start.
And how long does this process sort of take, right? From the initial conversations that you have to the time that you actually say go or no go as to both funding and to insurance?
I think it does depend a lot on the complexity associated with the case and how many issues we need to do due diligence and how we due diligence them. For example, are we paying for experts to provide an independent opinion on certain things, or are we comfortable doing it all ourselves? But realistically, I think in average terms, it takes at least 2 months for a merits case. That's a case that hasn't been initiated yet, and it can take up to 3 or 4 if it's really complicated.
Yeah. So it's interesting. So from an insurer perspective, it can take as little as 2 to 3 weeks to get a policy in place. That's for a very simple vanilla claim where all the documents are ready and everyone wants to, everyone's ready to go, and there's not any outside diligence that's required. Often if a funder is approaching and has already completed that diligence, so a funder is approaching us as a broker, they've already completed that diligence, again, that can speed up the process. And then it's just a matter of getting the terms, picking the insurer, and then finalising the LFA and aligning that to agreeing the waterfall of proceeds and all of that sort of stuff. So, that can take some time to negotiate, but there's no reason why it can't be done in a matter of weeks. Saying that, we've been approached on policies in February last year that we've only just bound. So, it can take time, depending on many other factors. And normally it is to do with how ready the claimant is to proceed. But, we don't mind it taking time. We want to be approached early. We want to be part of the conversation, assist with the strategy and kind of form the overall picture of that. So, that's where we would like to be instructed earlier rather than later, where it's all urgent and there's loads of deadlines and the insurers don't have a long enough time to review stuff. So
yeah, and just I think to supplement that, it's really very rarely time lost. I mean, when you think about this process where we're looking at the key issues that go to your case, and we're interrogating them and asking the questions that eventually will probably be asked in an arbitration. And so I think it's actually a very, very useful process, and clients use it to help them make decisions about the best way forward and their litigation.
Yeah, and a lot of the way that funders also can speed up the ATE, the insurance process, is by having a facility arrangement. So, Omni have one, and a few other funders will have these as well, where either a broker is appointed and there's a panel of insurers that the broker will approach. the insurers trust the diligence that the likes of an Omni have undertaken, and therefore terms are available quickly, wordings can be agreed quickly, and so the insurance isn't ever going to hold up that process. So that's a really good way of speeding up the insurance being signed and making sure that that doesn't hold up the signing of the funding agreement as well. So
Yeah. And Mitch, I just wanted to ask also if there's sort of like an initial funding available. So sometimes if the client wants to take advice and decide on whether to proceed with the claim and also wants to get funding, but doesn't have enough, finances to get a substantial advice, is that also available as a starting point?
It can be. I think it depends, like any investment, if we think based on what the information we have, that is worthwhile spend of funds. But it certainly can be, especially if there are scenarios where the client just doesn't have the capital, and that's clear to us, but they have a good case.
I mean, there's quite a lot of due diligence that goes into funding and insurance, varying degrees of timeline. So once you get into that relationship with the client, so the party who's getting funded, in practice, how is the interaction between the funded party and the funder? So let's start with that. Because there are obviously reporting obligations that funded party needs to comply with under the funding arrangement, and you need to be apprised of the case as it goes on.
Yeah.
And we had earlier discussed a little bit about control and autonomy and the tension sometimes between that and the perceptions of control. So what's the interaction like? And I mean, in practical terms, maybe is there any examples of cases that you've come across where you've had really good, relationships with the external counsel and clients?
Yep. So I think really this starts at the outset. And I say that because I think it's so important to be aligned in terms of expectations and also the strategy going forward. Because if those discussions don't take place, then people can get surprised. So I think that's really the key thing. And it's also discussing, what is an acceptable settlement range really at the outset, again, to ensure those alignment of expectations. Then once the funding agreement is signed, as you mentioned, Katie, there will be obligations to provide information to the funders. Practically, maybe that may be a call with the lawyers every month, every 2 weeks. It really depends on the preference within the legal team, the client, on how they wish to engage with the funder. Maybe some of them like suggestions coming from the funder and welcome them more than others, in which case usually that can be facilitated. But it really depends on the specific case and what the clients and the lawyers are happy working with as well.
What's the interaction like, between the
So the interaction, it's fairly light touch, I would say. So if you on a typical ATE policy, there are reporting requirements built in. The most basic one of those is either a quarterly or a 6-monthly update. The insurer will provide a pro forma document that the lawyers can add onto their system, and a reminder that they have to kind of give a brief update. And they're normally very simple questions about developments in the case. The other reporting requirements are where there might be a risk of adverse costs from a certain action. So or where the case may be settled, but for example, you've decided to reject an offer, they would want to understand why, and is it a reasonable offer? Why isn't it a reasonable offer? Why is the advice saying to carry on? So there are kind of any material development in the case that could give rise to an adverse cost exposure. They will expect an update at that stage, out of kilter with the normal 6 months. So if they're generally every 6 months, otherwise, if there's a key development, then they expect an update within a certain time frame. And sometimes there is approval required to take a step, and the insurers will provide that approval promptly via, well, the broker will approach the insurer and ensure that the insurer provides that promptly, so that it doesn't impact on you progressing the case. And then on contingent risk and arbitral default, I mean, on arbitral default, I think, yes, there is reporting requirement and there will be updates. But for contingent risk, I think really it's, there's not as many onerous reporting requirements other than just to keep, probably an annual update or information requested as and when. So again, it's all centered around any material adverse developments or any material developments that could impact the risk.
So essentially acting like a prudent uninsured, basically.
Absolutely, yeah. Prudent uninsured, yeah.
Yeah. So, I mean, we were talking about settlement and assessment offer being put forward and being considered reasonable or not. Just going along that line, can funders or insurers dictate if and when a case settles? That seems to be another myth that we have to deal with and sort of counteract. What protections are in place basically to ensure that the client's interests remain paramount? And is there such a thing as forcing a settlement? Because that doesn't sound to me to be realistic.
Yep. The funder can't dictate the settlement. It cannot say any settlement value, you must accept it. That can't be done. But of course, there is a commercial element as well. If the funder is spending large amounts of capital on a dispute and the client has very unrealistic expectations about settlement, then that is also problematic. So, a claim might realistically be worth, let's just assume $50 million, but the client's decided it's worth $1 billion. And there is a huge void between the realistic amount and the expectations. I think it would be very uncommercial for funders to do business if there wasn't any way to bridge that gap. And so how funders typically do it, and I think it's not dissimilar in insurance arrangements, is if there is a misalignment over a settlement offer, or a settlement offer is presented and the client doesn't want to accept it, there is usually an escalation mechanism to an independent third party, who could be a barrister or a senior barrister or a legal practitioner agreed between the parties, who will decide whether or not that is a reasonable settlement. So that's kind of the way that the gap is bridged in those situations. Again, it goes back to having those discussions at the start with lawyers, with the client and the lawyers, to work out expectations. And I think at that point, you can even agree on what a reasonable settlement amount might be when everyone's on the same page. So I think that's, in practical terms, how those risks are mitigated. Thankfully, that never had to use that escalation mechanism in any of the cases I've funded, but it is in most LFAs.
Yeah, and I would agree. The insurers deal with it in a very similar way. There's not a huge amount I can add to what Mitch has said, but yeah, so there'll always be escalation mechanism. Counsel of a similar standing will get involved as required, and that normally does resolve issues. Yeah.
That's fantastic. I think from the institutional perspective, we can often tell when a case is funded. When an arbitration is funded, it's fairly obvious to us. Certain things might come across in a particular way when they might not come across in that exact precise way in unfunded cases. But let's talk about, how that might shift in a settlement negotiation. So what happens when the other side knows that you've funded or insured a particular claim? How does that change the tenor of the settlement negotiations? And if you want to comment on how that changes the proceedings of the case itself as well, go ahead. Feel free to do so.
Well, from my perspective, I think it can often be positive because in most circumstances, I would say our funding is disclosed, so it's not a secret, especially in arbitrations, and so that's a sign of strength. I'd like to think that the claim's been endorsed and someone's investing in it, so that may be a trigger for settlement discussions. Perhaps I'd like to think sometimes.
And I would agree. I think if an insurer, a funder, any of those people have assessed the case, knowing what goes into the diligence to get to that point, to the case is funded or insured, as a defendant, I would think, oh, okay, clearly they've got some decent merits advice. There's been some strong analysis here, so it might make me think that, should I be trying to get out of this early? And also, if you've got the insurance in place and you've got the adverse cost cover all the way to the end of the dispute, well, that means that it could end up costing the defendant more if they don't play ball, if they don't actually be sensible and come to the table. So I think it really can be positive overall, and it really shouldn't affect any substantive defence of the claim. Typical delay tactics may still be employed, but really it can be a real tactical advantage for the insured claimant.
Thanks so much, Tom. Let me just pause there just for a minute to highlight to everyone that there is a Q&A function at the bottom of your screen. So if you do have questions for our panelists, please don't hesitate to type them in, and we'll try and answer your questions live. And Katie, just handing over back to you.
Yeah, thanks. There is an interesting question in the Q&A, which is, if the party and the funder or insurer are in disagreement as to who the neutral person is, so i.e. the guy that decides or the lady that decides, whether a settlement is reasonable or not, then is there a mechanism in the funding agreement as to how that deadlock is resolved?
So there's a few options. One option is you can agree at the start at the LFA who would be an acceptable umpire, if you like, even before you start funding the case. And there are examples of that. I think in most funding arrangements, there might also be a fallback mechanism to an institution or appointing body that can make that decision. It really depends on where you are and what the client is, where the client is, to gauge which type of institution would be acceptable. So that's usually the fallback for that scenario.
Yeah, it's a very similar fallback as well. So normally, if we can't reach an agreement, they'll be nominated or a body can assist with that, and it really depends on, as Mitch says, where the claimant is and what the jurisdiction is and all those sorts of things. But yeah, hasn't ever arisen that we aren't able to land on someone, but never say never.
Yes, indeed. And so that sort of gets into an interesting area where we're discussing alignment. So that's taking a step back and looking at the objectives of funding or insurance and the clients or the claimant or the funded parties' long-term business goals. So how do you align your offering with the funded parties' business goals? So say, for example, they are more concerned about reputational outcomes over damages, or they are bent on getting some kind of injunctive relief, but you think it's not a goer, then how does that play out in the relationship between the funder and the funded party, or the insurers, the insured?
So from an insurer perspective, I would say if there isn't a damages award, it just changes the premium structure. So typically with after the event insurance, the premium is split into two parts. So you'd have a deposit premium that's paid when you set up the policy, and then you have a deferred and contingent premium, and that's normally paid from on success from proceeds, similar with the funding return. If there wasn't a monetary award and the claimant just wanted to, or the insured just wanted to protect their adverse cost exposure, then there are other mechanisms. So you could increase the premium up front and reduce the deferred, or remove the deferred in its entirety and just pay a fair price for the upfront premium. But it's still going to be significantly less than the total adverse cost exposure that you're facing, and it caps that liability. So it can still be useful even where there are no damages awards, as long as you're kind of happy to exchange with a slightly higher premium from the outset, or guaranteed to pay a premium even though there are no proceeds on a deferred basis. So yeah, insurers can really just tweak the for what the client wants to achieve, and as long as there's alignment of interests and the insurer is happy with the prospects, there's always a way of doing things.
Right.
I think the honest truth is, for a funder, really a remedy that doesn't involve a monetary award is difficult, very difficult, and probably something that would be unworkable in most cases. As to kind of those factors around ongoing business relationships and how that might drive conduct in a dispute, and often settlement at what we would say below the claim's fair value. I think, again, those issues are quite difficult to navigate, but not as insurmountable as the relief. For example, we could agree that X represents a reasonable settlement, and anything above X, and therefore, even if it is a discount on what we would say is the claim's fair value, so long as that would be economically viable, then that would be a way to proceed. But that's not easy. I think really it does create difficulty in a funding context.
Yeah.
Yes, indeed. And in terms of, so looking at giving takeaways to the audience here today, discussing funding and insurance, I'm going to take a step back and consider the surprises that Mitch had earlier mentioned, meaning that, sometimes if you don't discuss the expectations at the outset, then sometimes there might be some surprises that come along the way when you haven't put all your cards on the table as to what you want to expect in terms of the outcome of the case. So have you seen examples of, cases that really didn't go as planned? I'm sure they're few and far between. And if so, then what is one key takeaway that each of you, would have from such a situation?
Yeah, I think one area which often creates difficulty is just around budgets and budget management. And again, that's also about managing expectations with the lawyers and the experts in that initial discussion. And I think deals that are structured poorly perhaps are more at risk of those types of issues that arise when there is a budget overrun. So I think ensuring that there is sufficient budget and a way to, and if not, and ways to deal with the risk of budget overrun at the outset is really very important. Because if you think of it from a funding perspective, if we've modeled a case on the basis of a budget of X, and that becomes a 1X, it not only impacts the funder's economic viability or the economics and metrics, it also can eat into the client's return, which is something that we always want to avoid.
Yeah, and the key for the issues we do find often is, from the insurance perspective, is if the cases do grow larger than necessarily anticipated, or the insured claimant is maybe trying to only insure a certain amount of adverse cost exposure, and then it suddenly isn't enough, then getting a top up to the indemnity can cause problems. Often insurers may the existing insurers or syndicate of insurers may say sorry, we can't provide any more indemnity. So then, as the broker, we would have to go out to the rest of the market. If the existing insurers won't top up, then that gives a question to the rest of the market saying, well, why won't they top up? And then that becomes often a lot more expensive. So not saying it's not possible, but my advice would be be very conservative with the amount of adverse costs that you think might happen. And the premium is really, you're not paying the full premium if you settle early. It's only really if you're exposed to those costs at a final hearing. So try and avoid top-ups at all means, because they can really be chunky at the back end, and also hard to source. So
Yeah.
And then generally just meet the reporting requirements in the policy and make sure you've got a broker that's going to help you do that and send you a reminder to make sure that you are going to meet the requirements.
Yeah. Thanks, Tom and Mitch. Very insightful.
Thanks, everyone. So thank you very much, Omni Bridgeway and Aon, for your support of this series. Thank you very much to our amazing faculty for today, Katie Chung, Tom Hunt, and Mitch Dearness. We will have a final episode in this series on third-party funding and insurance that we will be announcing details of shortly. Please look out for that. If you would like to learn more about the AAA-ICDR and our institution, as well as the initiatives that we run, please do check us out at www.icdr.org or check us out on LinkedIn at AAA-ICDR Asia Case Management Center. Thank you, everyone, for joining us today. We hope to see you at the next session. Have a great evening.
Thank you very much. Thank you, everyone.
Thanks all.
Thanks.